Let's get more with Barry Knapp. He's managing partner and director of research at Ironsides Macroeconomics. What a 24 hours, Barry. What's your main advice for investors right now?
First of all, those were a couple of incredible segues from Dom and from Rick Santelli in particular to my thoughts on all this. I started to write out a little bit of a note, and I described it as the valuation comeuppance. And so coming into the Fed meeting, I thought that there was scope for a serious relief rally in equities, in the front end of the Treasury market, both of which I thought were reasonably appropriately priced for the projected Fed path, for the inflation outlook, which we could certainly talk about because I do think it has peaked. But within the equity market, there's still seriously overvalued parts. And Dom spoke to that, which is tech and tech-related sectors, as well as defensive sectors, are still really rich and have not resolved this valuation problem. The other parts of the market, though, that were going to participate in the relief rally, and I thought it would last a little bit longer, was the long end of the Treasury market. But again, there, it is ridiculously priced. The term premium on 10-year Treasuries, 10-year real is still negative. 10-year real rates are only marginally positive. This speaks to the colossal Fed policy mistake, right? People talk about the mistake of still easing last year. It was the fact that they drove 10-year real rates so low and so far below the inflation expectations that's misallocating capital and causing that overvaluation in other parts of the stock market.
How do they fix it? So, Barry, to your point, I mean, we've had sort of a dot-com era correction in a lot of tech stocks. Even back then, we had a two-quarter recession, basically a relatively mild one. We had nothing like the inflation dynamic that we have today. So what should the Fed do right now?
Well, you and I were emailing about this a little bit yesterday. First of all, they should not be so tentatively moving into quantitative tightening. This is really disconcerting that the vast majority of easing through the pandemic was not the 150 basis point rate cuts. It was unlimited purchases of treasuries and mortgages, and then 120 billion per month, long after they should have been doing that, drove their holdings to a third of the agency mortgage-backed securities and treasury markets. Then when they announced the taper process or the start of QT, they're going into that very tentatively. That's what they really should be doing, is trying to unwind that and move those longer-term rates significantly higher to cool off housing, to cool off all this malinvestment.
Yeah.
And yet instead, they're going to jack short rates up. So, yeah, okay, they're not going to do a 75. Big deal. The real easing was in their QE purchases, so they need to get on with QT and stop being so tentative about it.
That's exactly what Dave Zervos and others have been saying as well. Barry, so let me ask you, at a time when most investors are kicking themselves for being in equities, thinking, I should have waited, I should have done something else with the money, I don't know where to go, your advice here is to reduce cash and add equities, that you can still be overweight equities. Am I right on all of that?
Yes, I think you should be putting money to work in cyclical stocks. I mean, there's a lot of price action, relative sector performance that looks like it's late cycle behavior, but it's also the cycle behavior you see when the Fed starts normalizing policy. 1994, this looks very similar to 2004, 2010, 11, 16. So this is what happens. These sectors are very reasonably priced, and inflation has clearly peaked in goods prices. House prices are next. And I can see that in the correlation of the various cities in the 20-city CoreLogic Index. It's come down hard. House prices are going to roll over. And then wage growth in the sectors that led the wage declines, and this will be big tomorrow, meaning trade and transportation and manufacturing, those look like they've peaked as well. Participation's picking up to an extent. And I think the Fed is going to get their opportunity to slow the process later this fall.
All right.
So if you've priced the front end appropriately, and they're not going to drive us off an economic cliff, which I don't believe they are, then the cyclical parts of the market look really attractive.
Well, I appreciate it because, a lot of people who share your sort of diagnosis or concerns are much more cautious, and it's good to hear that this is still a place to be as this all gets fought out. Barry, we'll leave it there for now, and always appreciate it. Thanks for your time.
Thanks, Kel.
Barry Knapp with Ironsides.